Not even the man, the myth, the legend himself, Mr. Jerome Powell, was able to take the market out of the April balance area today as the FOMC rate hike decision came out, as well as the press conference that followed. It really only leaves two major market-moving catalysts left this week with the potential to get us out of this balance. Number one would, of course, be Apple earnings after the close tomorrow. That's Thursday. And number two would be the jobs report. That's the NFP and unemployment rate coming out Friday before the open. So keep an eye out for those catalysts. But for now, let's have a look at the technical information in front of us. On the bar-to-bar count here, certainly a lower low was produced, very nuanced. It was literally a 5-cent lower low. But the most important part here structurally is the fact that we've closed week on the lows instead of in the midpoint of the day's range like what we had on the Tuesday session. So noting this week close, I would say that there are really two things that the bears want to see into the remainder of this week. Number one would be consolidation that stays here underneath the lower edge of the weekly expected move and actually breaks and accepts underneath these two bar lows. For all intents and purposes, a 5-cent lower low, it's not really technically big progress in the downward direction. Once again, the close was more important there. So the bears want to see consolidation underneath these two roughly equal lows. Anything that does hang out here on the Thursday session sets up a break for the Friday session. But the question I would pose to you here is, do you really want to be shorting 406.15? We know that this is not a market that we can trust. We can't trust it as far as we can throw it. I mean, look at this breakdown in here. Came with a face-ripping rally on the very next 2 days. So I would say the more responsible idea and way to get involved on the SPY daily time frame chart, at least to the short side, would be to wait for some sort of consolidation and a break. And then you're just looking to participate on the lower high underneath 406.15. It's been that way for a while. I would also point out that, of course, we are slightly extended, or if that move were to unfold, we would be slightly extended from the lower edge of the weekly expected move. It doesn't mean that the market can't continue lower, but once again, stacks up as a data point to say, hey, you might want to be cautious about new money shorts as we're coming into a known area of support. For the bullish trade to unfold, obviously there's a lot of work to be done. There was no attempt at a higher low at the 410.35 that we were discussing on a possible pullback in the weekend update. So that trade is kind of off the table, obviously. If we move on down to something like the hourly time frame chart and get a bit more granular here, you can see why I was trying to make the argument for consolidation underneath definitely supports the bear case, right? You would be breaking and rejecting these equal lows. From a trend perspective, we would have highs, some sort of lower highs unfolding here, but more importantly, just producing a more significant lower low is still inside of, don't get me wrong, the daily balance area, which is why we're looking for consolidation, break, and then some sort of lower high underneath 406.15. If you're a market bull at this point in time, there's a couple of things you could watch for. Any sort of fake break underneath 406.15 with a higher low, that would be the key here. Higher low back inside of 406.15. There might be a little bit of an end of week squeeze just to get back towards the edge of the expected move. It doesn't mean that we're looking for the market to rotate all the way up to the top of the balance. We're not looking for a mirror image of what happened over here, but I'm just saying that there could be the potential for a long trade on a fake break only with a higher low back above 406.15. So watch out for that if you are looking for the long. Of course, the other situation for a long is taking out this set of highs at 412.75, something that does this. A higher low back above here is also tradable in the upward direction, noting that this is no longer really producing the opportunity for lower high continuation. So that's what we've got on the SPY daily and hourly time frame chart. A couple little nuances to point out from the market internals here. If you're not familiar with the screen top right hand corner, as you covered with a brief tutorial, certainly worth acknowledging that yes, there absolutely were some significant outflows from the market on the Tuesday session, paired with a very aggressively negative advanced decline line. But the nuance is, look at the cumulative build in the tick itself. Notice how it really goes flat on the Tuesday session. So this is indicative of new money sellers. This is also indicative of new money sellers. This, though, not so much. So again, this is only one out of the three major data points in the internals, but if they're not all agreeing, and we know that we can't really trust the market as far as we can throw it on the daily time frame chart here at a known area of support, would you really want to be that aggressive on the downside? Again, I would pose you that question, and hopefully the answer is not really until we have the confident proof of a lower high underneath 406.15. Let's go ahead and take a look at some other supporting evidence. Again, this is going to be an abbreviated session on tonight's episode. So here's the TLT. And I just want to point out that obviously as the market has been breaking down aggressively, the TLT has actually been seeing green. So on a relative basis, the flight to safety trade is creeping back in. If you take a look at this ratio, it's certainly not breaking this down downtrend resistance here, but it's threatening it. And that, if that were to unfold, would be a big red flag for upward continuation out of the S&P market down below. The other, of course, bond nuance, so to speak, is HYG, junk bonds, right? We've been talking about this for quite some time. The junk bonds have not lied to us once, so I really do weigh this heavily in the analysis. Notice what's going on here with the possible higher low in the SPX, whereas the HYG, if I clear this up, you can see we've got a lower low, right? So this divergence is certainly not confidence inspiring for a long-sided trade or any type of market recovery out of the ES and S&P equities down below. It's not quite a one-to-one. This balance right here is roughly the equivalent to this balance right here. Just because this is poking in does not mean that the S&Ps must come back into this range and rotate down here towards the bottom around 3,900. But once again, hopefully you can see how this is just more of a red flag data point that would not support the idea that we catch ourselves, for let's just say higher low at 406.15, then we rotate and do something like this. This falls into the slightly more pessimistic camp in our market analysis. Let's move back on over to the main charts here and just run through the remainder of the broad market. Then we'll tune out on tonight's abbreviated session. Do me a favor, hit the thumbs up button if you don't mind this abbreviated video. It's probably better than nothing, right? That's kind of my assumption here in releasing it. But anyways, QQQ, look above, fail, right? So we're back inside of the range. And the other noteworthy part is that yesterday, again, this is speaking in reference to Tuesday's range, we found support at that key 318 level and started to bounce off of it. With the FOMC release, obviously we're now closing back underneath, just like in the S&P. It's not so much the fact that this is a lower low. It is more of a lower low than the S&Ps, but it's the fact that the close is underneath that 318 level. Again, not all that confidence inspiring, definitely starting to feel more like a look above and fail, as we know the target should technically be the bottom of the range at 314. So the QQQ does strike me as being more quote unquote shortable, considering we're not opening at an area of support. We're slated to be opening right around, and I guess it could be considered an area of support, but I wouldn't think of it in the same way as I would the S&P, right? The S&P is opening here on a relative basis. So the QQQ strikes me as, if we are looking for shorts, the more tradable of the two market indexes. And once again, the idea would to be for a lower high intraday underneath that 318, and we're going to start to trade down towards 314 on the look above and fail pattern here. Now, if we go to the hourly time frame chart and have ourselves a little bit of a zoom, the same idea can be said about the upside trade that we discussed in the S&Ps, right? So that would be number one, something that does this with a higher low back above 318. Now you're going to start to look at this as a double bottom. And as I typically and classically say on the channel, it's not really a double bottom until it is, which would require taking out the neckline, which is much higher up. It's actually above 320.50, which on the daily time frame chart represents the top of this balance range. So let's just note here that it really requires a stronger move above 320.50 if the bulls are going to have something more substantial going on. Don't get me wrong, intraday scalps, absolutely on some sort of recapture here. You can look to retrade through this thin structure up towards the 320.50, but I wouldn't overstay my welcome on the long side unless this actually is going to turn into a double bottom. Once again, the requirement there is taking out the neckline of that pattern. So just be mindful of that in your QQQ. If we take and of course, we talked about the short trade already, but right, that's something that looks like this underneath 318, a rejection in this area, 314 target. So now let's continue along back to the daily charts here. IWM last but not least here in the lineup. This is not the mini beast, that's Amazon. Last but not least, the mini beast. Here is the balance range. And this, again, should strike you as being more of a red flag for our market. This is certainly not confidence inspiring for any sort of big upside rotation or recapture or anything of that sorts. Noting that, again, if this is the balance area, this is the micro balance, we've already found on the Monday session the more meaningful lower high from here to here. So step number one, already complete for flipping into a daily downtrend with highs, lower highs. Whereas the other broad market indexes, they've produced lower lows and higher highs, not really offering up daily trend. The IWM certainly offering up trend already with this lower high. Today's nasty upper wick looks above the previous high, closes weak, but not at the lows of the previous Tuesday session, which is noteworthy here out of the IWM. We have many more levels to be at least mindful of down here at the lows. Let's take a look at the hourly chart. It becomes a little bit more clear. You can see how over here was the rejection, right? And that's kind of where the breakout stems from. So you're going to want to use 172.75 in your IWM for tomorrow's session, basically. If we're opening underneath this area, again, the bears are in control, looking for that consolidation to remain underneath 172.75. That would be a bearish red flag for the bulk of the broad market indexes. And then we'll look for a breakdown there. That's going to be under 171. And because this has already tested, it's already tested, right? This is a situation where, again, after a daily lower high from here to here, I would definitely be more willing to go with the H pattern breakdown of the equal lows at 171 as opposed to looking for the short in the SPY at 406. Right? So the IWM here is telling us, and it has much cleaner signals around these lows, especially given the structure, as we've been pointing out here. Hate to beat a dead horse, but the stuff's important, right? The lower high is really why this trade is tradable to the downside in the first place. All right, so 171, equal low breakdown, lower highs continue in place. Ideally, we open and stay underneath 172.75. That sets up consolidation here, and there's your target coming from this area in, what was that, late March, right? That's going to be at 168.75. And again, this should ripple out across the broad market as bearish pressure. So that's really what I'm going to leave it off with for tonight's abbreviated session. Once again, if you appreciate a video instead of just skipping it altogether, let me know by leaving the video a simple thumbs up. Brief reminder that we're trying to hit 50,000 subscribers. So if you're not yet subscribed, consider doing so. We have a special edition merch line set to release when we hit 50,000 subscribers. So that should be a fun way to celebrate as well. Once again, hope everybody has a green trading week. Keep Apple earnings, keep Apple earnings and the jobs report top of mind as we move to Thursday after the close and Friday before the open. Those should be really market moving there. We'll cover them in the pre-market prep. And with that said, I wish everybody a green trading week.